So with everything that's happened recently in the Strait of Hormuz, I mean, we're talking about the world's most critical choke point for oil. There's one question that's on everybody's mind, in boardrooms from Tokyo all the way to Houston.
And that right there, that's the billion-dollar question. When this is all over, does everything just go back to the way it was? Or have we just watched the entire map of global supply chains get redrawn for good? The answer is going to shape how money and goods move for the rest of this century.
And calling it a billion-dollar question, that's actually a huge understatement. We're talking trillions of dollars in future investments for things like ports, pipelines, and ships. The stakes, well, they couldn't be higher.
Okay, so to get our heads around this, let's start with the first argument, the big case for a full snapback. This is the idea that, look, history and basic economics are like gravity. They're just going to pull everything back to the way it was.
And you know what? History seems to back this up big time. We've seen this movie before. After the tanker war back in the 80s, after those drone attacks in 2019, even with the more recent Houthi attacks near the Suez, what happens? As soon as the danger cools down, the ships start coming back to the fastest, cheapest routes. It's like a law of nature. And the logic behind it is it's brutally simple. It all comes down to cost. The Strait of Hormuz is the world's main oil artery for a reason. It's the cheapest way to do it, period. Going the long way around Africa, you're adding weeks to the trip and well over $1 million bucks to a single voyage. Plus, the entire system, these massive sprawling ports like Ras Tanura and Jebel Ali, it's all been engineered to feed into Hormuz. The pull of that existing setup is just immense.
Okay, but then there's this really strong counter-argument, and it's gaining a lot of traction. It basically says, hold on, this time really is different. The very economics of global trade have been shaken up for good.
And the whole thing, it hinges on just one little variable, insurance. More specifically, this idea of a permanent Hormuz risk premium. See, this isn't just about a temporary price spike while things are tense. This is about a permanent change in how insurance companies calculate the risk of even using the strait long into the future.
And this is where you can really see the new math at play. What used to be a tiny cost, like 0.25%, could now settle in at 1, 2, maybe even 3% of a ship's value. Now, for a modern supertanker, that takes a small fee and turns it into a multi-million-dollar charge for every single trip. Suddenly, those other, longer routes start to look a whole lot more reasonable, even when there are no missiles flying.
And get this isn't just talk. People are already putting their money where their mouth is. Saudi Arabia is hitting the accelerator on expanding its port on the Red Sea. The UAE is seriously looking at a pipeline that would just bypass Hormuz altogether. And the big buyers in Asia, Japan, and South Korea, they're already signing new long-term deals to get their energy from places like the US and Brazil. The shift is already happening.
So you've got these two really strong arguments clashing, right? Well, to figure out who might be right, we can look back in history. There's this incredible parallel with the Suez Canal that gives us a huge clue.
So check this out. The Suez Canal, it's been shut down twice in modern times. The first time, back in '56, it was closed for about 6 months. But the second time, starting in '67, it was shut down for 8 solid years. The key difference here was just how long it was closed.
And the results? They couldn't be more different. It's night and day. After that short closure, bam, everything went right back to normal. But after the long one, well, the world didn't just wait around. It adapted. Companies started building these new, massive supertankers specifically designed to be profitable going all the way around Africa. Trade patterns got completely rewritten. And when the canal finally did reopen, some of that traffic never came back. It was gone for good. So what's the big lesson here? It's simple. Duration is everything. A short crisis is just a headache. The system absorbs it. But a long one? That forces real, permanent, structural change. It literally reshapes the world.
Okay, so with that history lesson in mind, what does this mean for the future? Well, it pretty much boils down to 3 possible scenarios, and they all depend on that one key thing, just how long this crisis really goes on.
So, scenario 1, things get resolved quickly. If that happens, you'll probably see an almost complete snapback, with most of the traffic returning to Hormuz. Then there's scenario 3, the extreme version. This becomes a never-ending problem. That would trigger a massive, permanent shift away from the strait. But the most likely outcome seems to be right there in the middle, a partial restructuring. The crisis has already dragged on long enough to make people nervous and lock in some of those changes, meaning maybe a third of the trade finds new routes permanently.
But, beyond all the numbers, all the timelines and the balance sheets,
There's something much more fundamental going on here, and it might be the most important piece of the puzzle.
Think about it. For decades, global supply chains ran on one simple question: what's the cheapest, most efficient way to do this? That was the principle of use. But now, the question is changing. Now it's about trust. Can we trust that this route will be open tomorrow, next year? Can we trust it enough to sign a 10-year energy deal or build a new factory that depends on it?
And that, right there, is the real, lasting damage. It's not the temporary cost of rerouting ships. It's the permanent loss of confidence. The expectation of another crisis down the road is now baked into every single long-term decision. Because, well, you can clear mines from a waterway, you can reopen it to traffic, but you can't just flip a switch and reopen trust.
So, that leaves us right back where we started. What do you think is going to win out? Will that powerful economic gravity of cost and efficiency just pull everyone back to the old way of doing things? Or has the fundamental trust in this critical global artery been broken for good?